Yesterday, Monday, the S&P 500 had the worst sell-off in 2025. Was this a pivot point for the markets? Hello, my name is Paul Carroll, the CEO and founder of Avion Wealth, an elite wealth management firm based here in Texas. So let's go over some of the fundamentals. The S&P 500 lost almost 2% yesterday. It's been going back and forth quite a bit, and it's down 5% since the high of February the 19th. United States manufacturing is stalling. Prices are jumping about 3%, and it looks like the Canada and Mexico tariffs are going to move forward. A little history lesson for context. The United States of America is essentially a 50-state free trade zone. The best, most powerful economy in the world is based on free trade. NAFTA added the resources of Canada and the cheap labor of Mexico to an economy that was otherwise out of growth potential. The United States is out of people, and we're utilizing all the resources we can. Add to the mix the Magnificent Seven, those are the big 7 tech stocks, have lost their luster. How to monetize AI is still really an unanswered question. We know that AI is fantastic and phenomenal and fascinating, but how do you make money? And what is one of the classic mistakes and misunderstandings of trade is by denying China access to our NVIDIA and other top-end chips, we basically have motivated them to find a workaround, and it is in the form of DeepSeek. And it's a heck of a workaround. It's crushing the valuations of NVIDIA. So much of this is basic economics 101 straight from freshman college. It actually makes my head spin when I see some of the policies that we're talking about today. Non-US markets are now beginning to look quite attractive relative to the future of the United States, and we're seeing those markets rally. And as we would expect with reduced industrial activity on a global level, oil prices are falling. Everything is so interconnected. You cannot push one button without another one popping somewhere else. Within the United States, equity markets are rotating from growth to value, and that's fine. For our clients, we've always had a value component as a buffer and / protection against overheated growth equities. With the U.S. domestic equity markets, we're beginning to see this rotation from the hot growth stocks to more traditional value stocks. Historically, value's really done well, so this is not unexpected. And that is why we've always had a value component in our asset allocation. Protecting ourselves from this kind of foolishness is also why we've always had exposure to non-U.S. markets. Not that we ever wanted that exposure, but that exposure is paying in dividends this year as non-U.S. markets are pulling away. I've often spoke about how market timing is a fool's errand, but never before has a recognition of relative valuation and the value of diversification been more important. If you've got a solid plan, the right answer is stick to it. Don't get greedy. They've got a saying, bulls make money, bears make money, pigs get slaughtered. If you enjoyed this, subscribe, forward, feel free to call with any questions. We wish you the best of investment success. Thank you.